What if European oil standards coming in 2026 are about to expose which synthetic oils are real and which ones have been fooling you with refined petroleum all along? And what happens when oil companies are forced to meet stricter ACEA specifications that Group 3 hydrocracked oils might not be able to pass? After over 20 years watching oil industry trends and analyzing how European standards influence global formulations, I can tell you that 2026 is a turning point. Europe is tightening performance requirements in ways that will separate genuine PAO synthetics from hydrocracked pretenders. Today, I'm showing you exactly what's changing, which brands are already adapting their formulations, which oils might disappear or get reformulated, and whether this European shift will finally force transparency in the US market. This isn't about rehashing the Group 3 versus Group IV debate. This is about what happens next. Let's break down the future. If you watched my previous video exposing fake synthetic oils, you already know the Group 3 versus Group IV debate. You know that hydrocracked refined petroleum can legally be called synthetic in the US, even though it's not lab-synthesized PAO. You know, brands like Castrol Edge, Valvoline, and others use Group 3 base stocks marketed as full synthetic. That's the current reality. But 2026 changes the game, at least in Europe, and that ripple effect will hit the global market. Here's what's happening. The European Automobile Manufacturers Association, ACEA, is implementing updated oil specifications that go into effect in 2026. These new specs, particularly ACEA C6 and updated versions of existing categories, impose stricter requirements on low SAPS performance, extended drain capability, fuel economy, emissions compatibility, and thermal stability. The key difference is that these specs are becoming harder for traditional Group 3 hydrocracked oils to meet without significant reformulation or blending with higher quality base stocks. ACEA specifications have always been more demanding than US API standards. European engines run tighter tolerances, higher compression ratios, advanced emissions systems with particulate filters, and longer service intervals. The oils have to handle more stress for longer periods without breaking down. As ACEA tightens requirements further in 2026, the performance gap between Group 3 and Group IV PAO-based stocks becomes harder to ignore. Here's the technical reality. Group 3 oils can meet current ACEA specs with robust additive packages. You load up the oil with detergents, dispersants, anti-wear agents, and friction modifiers to compensate for the base stock's limitations. But there's a limit to what additives can do. When ACEA pushes requirements for lower ash, lower sulfur, lower phosphorus, the low SAPS mandate, while simultaneously demanding better wear protection, extended drain capability, and fuel economy, you start running into chemistry conflicts. PAO-based stocks inherently have lower volatility, better oxidation resistance, and more consistent molecular structure than hydrocracked Group 3 oils. That means you need fewer additives to achieve the same performance, which makes meeting low SAPS requirements easier. Group 3 oils require more additives to compensate for base stock limitations, but low SAPS specs restrict how much of certain additives you can use. That's the squeeze. So what does this mean in practice? Oil companies formulating for the European market in 2026 face a choice. They can reformulate Group 3-based oils with more expensive additives and accept higher production costs. They can blend Group 3 with PAO to improve base stock quality while managing costs. Or they can switch entirely to PAO-based formulations to meet specs more easily but at significantly higher cost. Here's what's already happening. Brands with strong European presence are quietly reformulating. Shell, which owns Pennzoil and Quaker State, is leaning heavily into their gas-to-liquid Pure Plus technology, a Group 3 Plus base stock that performs closer to PAO and meets European specs more easily than conventional Group 3. Shell is positioning GTL as their answer to stricter ACEA requirements. TotalEnergies, a major European oil company, has been investing heavily in PAO production capacity. They're expanding PAO manufacturing because they see demand increasing as ACEA specs tighten. That's a clear signal that Group 3 alone won't be sufficient for premium European formulations going forward. Mobil, which is ExxonMobil's consumer brand, has always used PAO in their premium Mobil 1 lines for European markets. They're not reformulating because they're already using base stocks that meet or exceed 2026 requirements. But their Group 3 blended formulations for less demanding markets might see changes. Castrol, owned by BP, is in a more complicated position. Castrol Edge in Europe will need to meet stricter ACEA specs, but Castrol has built their brand around Group 3-based formulations with fluid titanium additive technology. They'll likely need to either blend PAO into European formulations or significantly upgrade their additive packages at higher cost. Either way, European Castrol Edge formulations are changing, even if the label stays the same. Valvoline, Pennzoil, and other brands with significant European presence are facing similar decisions. Reformulate with better base stocks, upgrade additives at higher cost, or risk losing ACEA certification for European markets. Now here's the critical question. Does any of this affect the US market? And the answer is yes, but indirectly and over time. US API specifications are not as demanding as European ACEA specs. American manufacturers can continue using Group 3-based formulations and meet API SP or future API standards without switching to PAO. So in the short term, US consumers won't see forced changes. But here's what happens over the medium to long term. Oil companies operate globally. Maintaining completely separate formulations for Europe versus the US adds manufacturing complexity and cost. If a company reformulates their European product line to use PAO or PAO blends to meet ACEA 2026 specs, there's economic incentive to harmonize formulations globally rather than running parallel production. Additionally, consumer awareness is increasing. As European formulations shift toward higher quality base stocks, and as information spreads about the difference between Group 3 and Group IV chemistry, US consumers start asking why their domestic formulations use cheaper base stocks than European versions of the same brand. That market pressure can drive reformulation even without regulatory requirement. We're already seeing this with some brands. Pennzoil's Pure Plus GTL base stock is used globally, not just in Europe. AMSOIL uses PAO globally because that's their brand identity. Mobil 1's premium formulations use PAO in multiple markets. The trend is toward base stock harmonization at higher quality levels, driven partly by European regulatory pressure. Here's what I expect to happen between now and 2028. Brands with strong European presence will reformulate their premium synthetic lines to meet ACEA 2026 specs. Those reformulations will either use PAO, PAO blends, or advanced Group 3+ like Pennzoil's GTL. Some of those improved formulations will eventually roll out to US markets as companies harmonize production. Budget synthetic brands that compete purely on price will continue using conventional Group 3 in the US market because API specs don't force change. But the premium tier will shift toward better base stocks globally. Pricing will increase. PAO costs more to produce than Group 3. If premium brands shift to PAO or PAO blends to meet European specs, production costs rise. Those costs get passed to consumers. I expect premium synthetic oils to increase $3 to $5 per 5-quart jug over the next 2 to 3 years as reformulations roll out. Budget brands using Group 3 will maintain lower pricing, which will make the quality gap more obvious. Some products might disappear or rebrand. If a brand can't reformulate to meet ACEA 2026 at competitive pricing, they'll exit the European market or reposition as budget products. We might see consolidation where weaker brands get absorbed by larger companies with better base stock access and technical capability. Now let's talk about what this means for you as a consumer. If you're buying oil in 2026 and beyond, pay attention to whether formulations are meeting European ACEA specs or just US API specs. ACEA indicates the oil has been tested to more demanding standards. That's a quality signal even if you're not driving a European vehicle. Watch for brands that are transparent about base stock quality. Companies investing in PAO production or advanced base stocks like GTL will market that chemistry because it differentiates them. Brands staying silent about base stock type are likely sticking with conventional Group 3. Expect premium oils to cost more, but understand that you're getting better chemistry if the brand is reformulating to meet ACEA 2026. A $35 5-quart jug in 2026 using PAO or advanced base stock is a better value than a $25 jug using conventional Group 3, especially if you're extending drain intervals or driving demanding conditions. And if you're buying European vehicles, BMW, Mercedes, Audi, Volkswagen, Volvo, make sure the oil you're using carries current ACEA certifications. These engines are designed around European oil specs, and using oils that only meet API standards can cause problems over time. Here's the geopolitical angle people aren't talking about. Europe's regulatory pressure on oil quality is part of a broader emissions and efficiency strategy. Stricter oil specs reduce friction, improve fuel economy, and lower particulate emissions from engine oil consumption. As Europe tightens environmental regulations, oil quality standards follow. The US may eventually adopt similar approaches, especially as federal fuel economy standards increase and emissions regulations tighten. China is watching Europe's lead and implementing their own strict oil specifications for domestic vehicles. If both Europe and China demand higher quality base stocks, global production shifts toward PAO and advanced synthetics regardless of what US regulations require. The market moves even without US regulatory pressure. So here's what's different about 2026 compared to the Group 3 versus Group 5E debate we've had for 25 years. This isn't about legal definitions or marketing semantics. This is about performance requirements that hydrocracked Group 3 oils will struggle to meet without significant reformulation. Europe is forcing the issue through ACEA specs that favor PAO chemistry. Oil companies have to adapt or lose market access. Some brands will rise to the challenge and reformulate with better base stocks. Those brands will deliver genuinely improved products globally as formulations harmonize. Other brands will stick with Group 3 in markets where they can, maintaining lower costs but falling behind on performance. The quality gap will widen, and consumers will have clearer choices between premium PAO-based oils and budget Group 3 products. The era of pretending all full synthetic oils are equal is ending. Europe's 2026 ACEA specs are the catalyst that forces differentiation. Pay attention to which brands are reformulating, which are investing in PAO, and which are staying silent. That tells you who's committed to quality and who's committed to protecting margins. Here's the bottom line. European ACEA 2026 oil specs are tightening performance requirements in ways that favor Group 4 PAO base stocks over Group 3 hydrocracked oils. Brands with European presence are reformulating now. Some of those improved formulations will spread to global markets, including the US. Pricing will increase for premium synthetics using better base stocks. Budget Group 3 products will remain available, but the quality gap will be more obvious. Watch for ACEA, CEA, CEA, base stock transparency, and brand investment in PAO technology. The oil industry is changing, and 2026 is the inflection point. What oil are you planning to use in 2026 and beyond? Will you stick with budget Group 3 or invest in PAO-based formulations as they become more available? Drop a comment. And if this forward-looking analysis showed you what's coming in the oil industry, hit that like button. Next week, I'm breaking down which specific oil products are already ACEA 2026 compliant and which ones will need reformulation. You need to see that. If you're not subscribed, hit that button now, drop a comment. I respond to everyone. Thanks for watching. I'll see you in the next one.